Thanks so much for joining us for today's webinar on financial planning and models for tourism businesses. This session is being delivered as part of a COVID-19 Tourism Enterprise Development Programme. We are delighted to be joined today by Feargal McCormack, Managing Director, PKF-FPM, who will be sharing some useful insights with us shortly. This is a challenging time for the sector and individual tourism businesses across Northern Ireland who are trying to plan and manage within the continued uncertainty arising from COVID-19. In the current climate, it is difficult to make any predictions. In the medium to longer term, the tourism sector is not likely to return to pre-COVID levels for a number of years, and the majority of demand is likely to be from closer to home markets. But the continued uncertainty as we enter into the low season and the extent and duration of restrictions unclear, it is an imminent concern for tourism businesses. We are committed to supporting Northern Ireland's tourism industry in these challenging times. There is no one solution for the wide range of businesses across the sector, so we would encourage you to look at the range of support available. You can access the existing COVID-19 support materials as well as signing up for webinars and expert advice on tourismni.com and covid19.tourismni.com. Through our Tourism Enterprise Development Programme, we will continue to roll out supports for the industry, including webinars such as these and a range of online supports. Based on advice and requests from the industry, we are at this time prioritising support in the area of business and financial planning, but please continue to let us know what you need and we will make our best endeavours to support. If you can complete the feedback form you will receive following today's session, we can continue to tailor our support programme to industry needs. There will be an opportunity also following Feargal's presentation for a live questions and answers session, and we hope you find this useful. We will also run through how you can get in touch with Tourism NI and our advisors if you have any further questions. It's my pleasure now to hand over to Feargal McCormack for the main presentation. I hope you all find the session useful. Thank you.
Good afternoon. My name is Feargal McCormack. I'm Managing Director of PKF-FPM Accountants, and I'm joined today by my Senior Manager colleague, Ashok Thomas. And together, we're delighted to have an opportunity to present today's webinar on an introduction to financial planning models for tourism and businesses operating within the Northern Ireland tourism sector. The webinar is being delivered as part of Tourism Northern Ireland's new Tourism Enterprise Development Programme. And at the outset, should I explain that the slides should be an aid memoir, and we may not necessarily talk to each slide, but hopefully the slides will act as a reference long after the webinar is concluded. The webinar is designed to help businesses with more than 25 staff operating within the Northern Ireland tourism industry hopefully survive and recover from the unprecedented events we're currently experiencing. It's fair to say COVID-19 has caused a level of unrest and volatility no one could have anticipated. We'll endeavour to offer a comprehensive overview and refresher of the key areas that businesses should be considering while planning and managing the financial needs of their business. I suppose what we're saying here is we all know the broad issues, but we're just trying to get to refresh the basic understanding in order to allow us then to go to a more sophisticated stage in terms of profitability analysis, etc. We hope to provide some practical tips and advice on how to navigate through uncertain times with smart financial planning. And my colleague Ashok will provide some introduction to financial modelling. And it's also fair to say at this stage to highlight that that one-to-one mentoring may be available to enhance knowledge and understanding of specific elements of financial management. And at the end of the presentation, I give you an email address that you can contact Tourism NI if you wish to follow that up. But the evolving coronavirus pandemic means that we are currently living in unprecedented and extraordinary times. And as we all know, the current second wave is creating further challenges for the tourism and hospitality sectors in terms of uncertainty, public health guidelines and government restrictions leading to, as we already said, volatility in economic activity. And whilst it is acknowledged that the UK government, the Northern Ireland Executive and government agencies such as Tourism NI and Invest NI have endeavoured to bring in business supports to help businesses, employers and employees, the truth is that the COVID-19 pandemic is hurting the tourism sector, and it's very difficult to predict future market dynamics. because if you think about it, we're now faced with a triple level of uncertainty. First, around the coronavirus itself. Secondly, in terms of its economic impact. And thirdly, the ways in which the pandemic has and will affect people's behaviour. The reality is that the pandemic will come to an end, but that timescale is currently unknown. Therefore, in the short term, from a business perspective, we would suggest that we must financially plan for living with and post-COVID-19. Yes, things will be different. Some behaviours and attitudes will have changed. There will be a greater need for business model agility and to understand key issues we suggest concerning the financial management of businesses. We would also suggest that there will be a demand to accelerate digitalisation and that health will become a fixation and that environmental, green and sustainability issues will come to the fore. Hopefully the webinar will provide you with a greater understanding of business model, legal status, financial statements, commercial profitability being a key element of the webinar, funding, working capital, and as I said before, some practical tips. And certainly, I would hope we whet your appetite in terms of financial modelling and how you can best use that to be most effective within your own business environment. But it's fair to say that it's always important to establish the baseline and to recognise that our present circumstances don't determine where we go, they merely determine where we start. So we would suggest that there are 5 strategies that businesses should consider to survive in the current climate. Yes, embrace lateral thinking, adopt a risk management strategy, including scenario planning, recognising that failing to plan is planning to fail. Certainly there needs to be an emphasis on cash flow management and cost reduction strategies, and also a need to reflect on current and anticipated market dynamics, including, as we all unfortunately know, the collapse of out-of-state visitors in the short term and the growth in staycations in the months of July and August. Again, sadly, just at present, due to restrictions, we're not able to avail of that business. And take a holistic view of our businesses to reflect on what we did before, what we did during COVID to date, both in a non-trading time and a trading time, when we were permitted to trade, and what perhaps we could do better, and what we didn't do before, that we should go for in the future in terms of products or services, sales mix, processes, etc. And as I've intimated earlier, we personally believe that profit maximization is key in the current environment. So, what we're really saying is that if you look at the business model, which is what all our businesses ultimately are a business model. And the success of the business is ultimately dependent on how effective your business model is. And it's fair to say that in our experience, good business models are based on a valuable formula. You know, you can summarize it many different ways. You can say it's the what, the why, the who, and the how. But the reality is, it's very important to appreciate that the most important thing is not the what, the who, or the how. It's the why, because it's about purpose. And if you think about it, customers will not purchase our tourism products or services because they understand what we do and how we do it, but rather they'll buy our products or services on the basis of the results they perceive our tourism products and services will bring them. And equally, if you think about it, what this really means is when their why and our why are the same, we have a sale. Now, certainly in terms of PKF-FPM, we believe that a business needs direction and it needs structure and processes. And to facilitate that, we have developed a strategic management holistic tool, which actually we call, believe it or not, the PKF-FPM Rocket. And what this really says is that the strategic plan takes the vision or develops the vision. So you start with vision, and then you put in place your strategy, structure, and culture. Culture obviously is the glue that joins it all together. And ultimately, your business plan then takes that vision, and it basically brings it to reality in terms of helping you achieve your vision through 5 operating functions at the end, which if you think about it, every business has. It's your products and your services, it's your marketing and sales, it's your people operating plan, it's your systems and processes, and ultimately your finance, physical and resources. Now, this may sound theory, but this is the reality. You can do this in the back of an envelope. It doesn't have to be a big, long document. But it is important that we pause for a second and focus. And it's also important that we appreciate that the business actually doesn't operate in isolation, and that every business is subject to pressures and influences from the external environment. So it's important we always keep that little bit of peripheral vision, looking around the environment in which we're operating. You know, you think about the old business theory tools of the SWOT analysis: strengths, weaknesses, opportunities, and threats. But again, remembering that opportunities and threats are basically, external to the business. So you could, for example, use the other tool, PESTLE, to help you do that: political, economic, social, technological, environmental, and legal issues. And quickly think, how do they affect your business? But the truth is that businesses thrive when both effectiveness and efficiency are aligned and complement each other. What do we mean by effectiveness and efficiency? Well, by effectiveness, we mean doing the right things. That is strategic, working on the business. And by efficiency, we mean doing things right. That is operational tactics, working in the business. And one of the things important to appreciate is also that the legal status of a business has financial implications for the business. Now, within the tourism sector here in Northern Ireland, there's probably three main forms of legal status. There's the sole trader and the partnership. Sole trader is a one-person business. A partnership is more than one people. It could be 2, 3, 5, but they don't have limited liability. They come together as a group of individuals. And then a limited company is a separate legal entity of its own. And why I'm highlighting these 3 points is, which is very important. When you go to compare businesses, the first question you need to ask yourself in order to assess performance is to understand, are they a sole trader, a partnership, or a limited company? Because depending what legal title they are will reflect how the owner's remuneration is withdrawn from the business. And you must adjust for that if you're benchmarking industry trends or indeed yourself against other businesses. Now, yes, there are some other structures operating in terms of the tourism sector here in the north. You have the not-for-profit company, limited by guarantee. You have limited liability partnerships, social enterprises, and franchises. So basically what we're hoping to do, first of all, is write a very simple refresher on understanding the basics of financial statements, because this ultimately, if we don't get the foundation stones right, then we're in quicksand. And believe it or not, one of the things we do pick up from time to time is that it's a lack of appreciation of the fundamentals of these 3 key financial statements that causes problems down the line for businesses. Because understanding these can be key to decision making. So what about the profit and loss account? Well, the profit and loss account is a statement which looks at combines your revenues, your costs, and your expenses incurred during a specified period for a year or a month, for example. And then, excuse me, the key lines you have in there is obviously sales and turnover. And it's important to understand that that reflects income from sales and products or services during the period, excluding VAT. Very important if the business is VAT registered. And secondly, we suggest that it's as easy, garbage in, garbage out. It's as easy at the outset, and you'll see why it's important to do this, because you want to really interrogate your business to become more effective. You need to, first of all, be able to isolate your key products or services into categories and be able to show how they differentiate in terms of generating different revenues and different costs of sales. So what we would suggest is you don't just use a bucket sales account and throw all sales into the one account. Divide them out a little bit as appropriate. In terms of cost of sales or direct costs or variable costs, these are costs that can be directly attributable to the production of the particular product or indeed the sale of that item, product or item. And it's important to appreciate that variable costs move in line with activity. Now, we hear that often, but we've got to really apply that when the opportunity comes within our business. So we have to ask the straight question: is this cost incurred only if we're producing or selling a product, or is it there anyway, for example, as a fixed cost? Then the gross profit, basically the contribution, is the difference between sales income, turnover, and the cost of sales. Whereas administrative expenses or fixed overheads are sometimes referred to, or fixed costs, they cover all operating costs not directly linked to producing the product or service. For example, rent, utilities, indirect staff costs, etc. They're not directly related to activity, and they are not included in cost of sales. And obviously, profit then is ultimately the difference between income and the business expenses. And other income, it's important to appreciate, is not turnover. So, for example, do not include grants or rent or capital introduced in your profit and loss account. It's also important, to be honest, to understand the difference between revenue expenditure, which is expenditure which is expected to be fully spent over a period of 12 months and the benefits achieved within a period of 12 months, as opposed to capital expenditure, where the benefits is expected to be achieved, to be realized over a period longer than 12 months, and therefore goes to the balance sheet. So if we move on a little bit, let's take an example very briefly, a sample profit and loss account. And you can see here, basically, I'm just comparing 2 years. And if you look at these 2 years, you can see in 2019, the sales went up 20,000. But look at the importance of percentages. Very important at an early stage to apply percentages. Don't look at figures in isolation in assessing a profit and loss account. So the gross profit, sales less cost of sales, 70%. You can see fixed overheads in 2018, 34,000, but grew to 44,000 in 2019, but the percentage actually fell to 55%. And then if you look at the operating profit, 15%, or net profit, 11% in 2019. Now, why do we do these type of things? Because it allows us to ask questions. And the questions aren't the most important thing, but it's the answers we get from those questions which allows us then to understand further the business. So, for example, in this case, you could ask, why has the gross profit percentage fallen from 73 to 70? For example, is it because we're operating in a very price-sensitive market? There's pressure pushing prices down? Is it because our direct labor costs have risen? Is it because our direct material costs have risen? Is it because our variable overheads have risen? And equally, an interesting question, and comparing these two sets of profit and loss account figures, is why has our fixed costs gone up by £10,000? Ignore it, because it shouldn't be affected by activity. And you can see, albeit our fixed costs as a percentage of turnover have fallen by virtually nearly 2%. But the reality here is that our net profit, a low increase from the previous year at 9,000 rather than 8,000, our net profit percentage has actually fallen. So our efficiency is not as good as it was. And there may be lessons there to read. And there could be any one of questions. I've just asked a few there just to highlight the type of things that we would be looking at. Now, in terms of the profit and loss account, to be fair, it's also true to say that we also need to be conscious of a few different terms. For example, the concept of deferred income, or the matching concept. And what this means is that basically, if you're paid in advance for a product or a service, for example, let's say somebody buys a gift voucher off you so they can give to somebody who will use it at some time in the future, or you get advance deposits for accommodation or weddings, that's deferred income. And the reason why it's deferred is unless you incur the expenditure to generate that income in the current period, then it shouldn't be included in this year's profit and loss account. It should only be included in the profit and loss account when the expenditure is incurred to justify that revenue coming in, to match that revenue. Equally, it's important to appreciate expenses and accrual accounting. For example, let's take accountants' fees, which are typically charged or invoiced after the year end, but they relate to the year just ended. So again, if that cost relates to the revenue just ended, of the revenue associated with the period just ended, you then have to accrue for that cost, even though you didn't get the invoice until after the year end. And similarly in that concept, there's a thing which is important to appreciate, which is an expense prepayment. For example, let's say some costs, for example, rent, are invoiced or paid in advance. So let's say you get an invoice for rent for £6,000, dated the 1st of March, and it covers the period from 1 April to the 30th of June. Now, if you think about it, the year ends March. So the period of that invoice happens to go into the next accounting period as well as this accounting period. So what you're really saying is that you really should only affect a third of that invoice, which is the 1 month, which is March, in the current period statement, the current P&L, which is obviously £2,000, and that 2/3 of the invoice, which relates to April and May, are actually, you can see I can't count, it's actually 4 months, but let's assume it's 3 months for the time being. 2/3 of the invoice then is actually treated as a prepayment and reflected as an asset in your balance sheet for the period ending 31 March, as at 31 March, and carried forward. So if we then move on and to acknowledge there are limitations to the profit and loss account because it doesn't show the solvency of the business, it is prepared on the accruals basis, and it doesn't show cash position. And it's fair to say that a number of businesses do not fully understand the matching principle and get it wrong. So if we then move on to the balance sheet and understanding the balance sheet, Again, it's important to appreciate a balance sheet is not a P&L. It's totally different. A balance sheet is a snapshot at a point in time. Basically, at that particular date, it summarizes the net value of your business at a specific point in time, meaning the amount the world would be prepared to return to the shareholders if all the company's assets were liquidated and liabilities netted off. Now, it's fair to say that limited companies must prepare balance sheets as part of their annual accounts. And the balance sheet is a good indication of whether your business is solvent. What does that mean? That's your net current assets, if you have them, the ability of the business to meet its liabilities as they fall due. It also shows all the assets, anything which is owned by the business or owed to the business, less the liabilities, which is actually all the money owed by the business to others. It's also very handy, by the way, for benchmarking. Now, I don't plan to go into this, but just to highlight, I want to show you a sample balance sheet here, and I've used very simple figures to highlight it. You can see the fixed assets, which are actually assets which have an expected benefit beyond 12 months, beyond 1 year. The current assets, which are assets which are expected to have a life less than 1 year, stock, trade debtors, cash at bank. Then you have current liabilities, which are liabilities, and this is very important, which are expected to fall within 1 year. Now look here, you can see there's a figure there that says loans £1,000. If I got £1 for every time I lift a balance sheet, and that figure is wrong, I'd be a wealthy man. What that means is, if it's in current liabilities, it's the element of the loan and only the element of the loan or the HP or the lease agreement that is due to be paid within 12 months. So if you have a loan of 30,000 and it's to be paid over 10 years, you should only have £3,000 in the current liability, and you should have £27,000 in the long-term liability. If you put the 30,000 as a current liability, you may not realize it, but you may be suggesting to a reader of your accounts that your business is insolvent. So it's very important you get that right. And then, as I've been highlighting there, long-term liabilities are liabilities beyond 1 year. And then that, once you add up basically your fixed assets and your net current assets, take off your long-term liabilities, you get what's called the net assets of the business. In this case, you can see 4,300, and believe it or not, they will then be equal to shareholders or owners' capital plus the retained profit for the year. So I've touched the key balance sheet terms, so I'm not going to go back over those again. And then if we move on then basically to the limitations of the balance sheet, well, it doesn't show profitability. It's only a statement at a point in time. It's a snapshot, as we said. And the assets are mainly recorded at historical cost. Now that's important, because that means if you bought an asset 5 years ago, it may well still be in your accounts at 5 years old. So you can, now and again, it may well be appropriate, and some businesses do correctly, carry out revaluations every 3 years and to reflect those in their updated balance sheet. But technically speaking, the assets are recorded at historical cost. There's also a number of estimates in the accounts. For example, your stock figure is fundamental to your balance sheet and your P&L. Also depreciation, which is the writing off an asset over its expected useful life. And then obviously there's the omission of valuable non-monetary or non-acquired assets. Now, I think I said it at the start, or implied it certainly, that cash is the lifeblood of any business. And you know, it's fair to say that particularly at present in the current environment, cash flow forecasts are a prerequisite for business success. Because cash flow enables you to plan for, cash flow forecasts enable you to plan for how much cash your business will need to keep trading, when it will be needed, applying for financing if there's going to be a shortfall, and managing excess funds, regulating spending, and drawing attention to any waste or inefficiency. Again, how do you prepare it? Well, look, it doesn't really matter. The concepts are the same way you prepare it manually, or certainly I'd be suggesting spreadsheets in Excel, and Ashok later on will certainly highlight how that is done, or you can utilize some excellent accountancy software packages out there now to help you. And all I want to do here is just in this example cash flow is just to discuss the layout, should you appreciate it. You can see the cash flow in this case is done monthly for a year. You can see it identifies what it calls as operating cash flows or working capital cash flows, which it identifies as sales or income coming from credit sales. It then has all the operating business expenses, and then you get what's called a working capital cash flow. And then under that then, You have capital income, which is if you introduce money into the business, or you get grants, or you get loans. And then you have capital expenditure. And then, having netted all those off, you come down to what's called the closing bank position. So you have an opening and closing bank position each month. Very useful. And to be fair, again, the key is it's not the figures themselves, it's the process that's important. Now, it's fair to say that in order to do this, excuse me, in order to do this, the reality is that you have to build up your sales forecast and make your assumptions, what proportion you think will be credit and cash, and then you make assumptions on debtors, when you expect you're going to get paid, and you look at your other loans, which is your capital introduced, and all those type of things. There's nothing hard about this. It's all common sense, but the most important thing is the thought process, to think and then to see where you reflect it, as I've shown in the previous example of where it actually goes within the cash flow statement. And again, Ashok will cover this briefly. So using the forecast in practice is far more important. You use it to compare what is happening in reality. How was your actual cash flow against forecast? And then you can all of a sudden say, should I change my assumptions? Should I revise my cash flow? And really, that's the important thing. It's a need to the decision-making process. It is not the cash flow statement itself. It's what it does. It's how it helps you run your business. But to be smart, to think a little bit more. Could I do this differently? Would that have a different impact on cash flow, etc., etc.? So again, I've given you some examples there of where things have moved. For example, if your cash sales are lower, what's the reason? In this case, it was very simple. We started trading a week later. But again, any one of them, you can look down, you can see the capital expenditure in this case was actually less than you anticipated. And again, the reason there was you negotiated a better deal in the equipment. So some hints. I would say in normal circumstances, and it doesn't apply at present because none of us could ever have had adequate reserves to trade out of the current pandemic without government help, in my view. But you should aim to have a contingency reserve of cash in normal circumstances. Now, I would suggest that you should be cautious about how quickly you assume your customers will pay you. But again, my colleague Ashok will come back to this whole key area of scenario planning, what if, and changing your assumptions. Now, certainly in the context of COVID-19, agreeing deferral terms for loans, asset finance agreements, tax, etc. And I would think if we're going to have the restrictions we currently have at present, that I think you will see the opportunity, hopefully, for deferring mortgages and loans, etc., coming back in again, as it was in March and April available. Indeed, unfortunately, if redundancies are required, you do need to provide for these in your cash flow statement assumptions. So what we're really saying is, if we haven't got it across yet, we'll say it again, cash is not profit. Profit is the difference between the total amount your business earns and all its costs, usually assessed over a period, which could be a period of a year or any other trading period. Cash is very simple. It's the amount you and I have at present on hand to pay our debts. Now, you can show, and I've seen it on a number of occasions, where business is showing a good profit and it still has to be strapped for cash to cover its immediate debt. And unfortunately, as we'll give an example shortly, is working over trading. I've seen profitable businesses actually go out of business, fail, despite making profits. And working capital management, which we'll talk on briefly later, does directly impact cash flow, and it really is fundamental to improving your cash flow. I referred to overtrading a few seconds ago. What is overtrading? Overtrading basically is when the business expands too quickly without having the financial resources to support such a quick expansion. If suitable sources of finance are not obtained, then overtrading is the problem of rapid growth and unfortunately can lead to business failure. Indeed, that's one of the reasons why, if you ever study successful business people, many of them either failed before or went close to failure. And believe it or not, overtrading quite often is one of the big lessons they've learned when they come back the second time. And the other lesson they've learned is this one: the importance, as we said before, that cash is not profit, and you've got to try and free up your profits. Very simple example here to explain this. Two businesses, business A and business B. You can see they have the exact same sales, 100,000, same cost of sales, 80,000, profit same at 20,000, and the same net assets at 20,000. What happens? Let's look at the two scenarios. In business A, basically, sales of 100,000, we have recovered in 40,000. So we've been paid 40,000. So we have trade debtors of 60,000 pounds. In respect of the cost of sales, we paid our creditors 30,000. We still owe them 50. So in reality, we have 10,000 pounds. We have trade debtors of 60,000 and trade creditors of 50,000. So we have 10,000 cash in hand, 10,000 pounds positive. However, look at scenario B. We've only recovered 20,000 pounds of our sales. So our trade debtors are now 80,000 pounds, but we're very decent to our suppliers. We want to make sure, they think we're great people, and more importantly, we hold on to them. And we pay them very quick. And we paid them 50,000, so we actually only owe 30,000. So in this case, our trade debtors are 80,000 and our trade creditors are 30,000. And the reality is that basically we have a bank overdraft requirement of 30,000. Now, that's a movement of cash flow of 40,000 between a positive cash balance of 10 and a negative bank overdraft of 30,000. And as I say, you want to work it out in your own time. The net assets are exactly the same, 20,000 as well. So what are we really saying here is very simple. The golden rule: turnover is for vanity, profit is for sanity, but cash is for survival and is the king, which is so important in the current business environment. I would suggest you need to seek help early and face up to any problems before they become unsurmountable. In my experience, most problems can be addressed if you identify them and then explore the possibility of solving them or restructuring your debt. And it may well be that you need to have a discussion with an insolvency practitioner, and maybe a creditor's voluntary arrangement or an individual voluntary arrangement may be required. But that may well be what's required to make the business sustainable going forward. Now, there are limitations of the cash flow statement which you should be aware of. For example, it fails to present net income or to assess profitability. It ignores non-cash items which are considered in the profit and loss account. It certainly fails to assess the liquidity of the solvency position of the business. And it definitely is not, and this is an important thing, it's not a substitute for the funds flow statement, which is prepared utilizing the matching concept. So what we'd like to now do is to actually take all those basic concepts and start to apply them to a subject matter that we think is really fundamental in the current environment. And that's called commercial profitability. And what does that depend on? Well, that depends on price or revenue and cost of sales. Price and revenue are market driven, cost of sales are controllable and internal. Thus, establishing the correct price and determining whether it is possible to make the sale at a profit requires an understanding of cost behavior and careful analysis of both the sales price and the cost of sales. And what we're really saying there is that we're looking at the pricing of products and services and the whole area of cost pricing. Now, I want to introduce you to a concept which some of you may be very familiar with, but it's called cost plus pricing. And this is actually the easiest way perhaps to eventually determine what is your desired price. When you sit down and decide, what price should I charge for my service or my product? Now, the truth is that in many circumstances, companies operate what's called cost plus pricing system, which provides a useful rule of thumb to setting the basic price. Now, or the base price, sorry. And what they do essentially is 6 steps. They first of all calculate the labor cost associated with making the product or service. They then add in the direct material costs associated with making the product and service, which is not normally that difficult to calculate. Actually, you can trace it back once you decide what the actual ingredient of the materials are. You can trace it back to invoices, etc. Establish the total variable cost, which is direct labor, plus, to be honest with you, direct materials and variable costs. That's variable overheads, variable that move directly with activity. And then basically that gets you what's called your gross profit, your gross contribution. Then you calculate the overhead recovery rate, which that's very difficult because at times you say, how can I allocate a proportion of overheads into a particular unit or product? And we hope to share with you now a reasonably easy technique once you understand it that will allow you to do that. And once you do that, you add up what you hope to be your desired markup, your profitability, and then you finish at your desirable sales price. And once you finish there, if you think about it, what you're really then saying is, if that's the desirable sales price, let's look at the market. Is a similar product dearer or cheaper out there? Could I make more money? Is my product or service better? Can I create differentiation and value added? But I have to know one way or the other, that this is the desirable sales price I'd like to get for it. So how do we actually then calculate? Let's take an example. Let's say George, for example. Let's say George has a gross salary of £20,000. You're paying employers NIC of 13.8%, and some benefits in kind, pension contribution, including auto enrollment. Let's say 1,200 quid. Let's say you pay a gym membership, and you maybe give them a Christmas bonus or whatever, summer bonus. So you're sitting at a total labour cost to the business for George of £24,460. And then you ask the question, well, now let's work out the direct cost of George per hour. Well, now you're paying him for 52 weeks a year, 37.5 hours a week, but actually he's only working about 44 weeks. Whenever you allow for annual leave, you allow for sickness, going to the doctors, you allow for training and maybe a little bit of business development. So the truth is he's not working 1,950 hours, which is 37.5 hours per week at 52 weeks. He's actually only working 44 weeks at 37.5 hours. So the actual cost per workable hour of George is actually 24,460 divided by 1,650 hours, the 44 weeks, which gives you a cost of £14.82 per hour. Now, be careful to appreciate that this cost does not include any provision for overtime. So if you're also paying George overtime, then you must reflect that in the cost to get a true cost back of labour. And equally, it's important to appreciate that the cost per labour hour is not, I stress, not gross salary 20,000 divided by 1,950 hours, which is 52 weeks at 37.5 hours, which you can see a massive difference. A difference, if you got your costing wrong here, of between £14.82 per hour and £10.26 per hour. You'd be out of business if you didn't understand the difference in these two concepts. Now, what I'm really saying is, this is a very simple example, but the truth is you need to include the total cost of labour before you then work out what is the cost per workable hour. You can obviously use timesheets, various different ways you can do this. Now, to calculate the unit material cost, what happens is you take a unit of product or service and you make a schedule of all the materials that make up that unit, and then you also allow for some wastage. And basically where you find out if you're right or wrong later on, all of a sudden you arrive at gross profit, which you'll come to, and then you compare actual with forecast, and then all of a sudden it might be unfortunately a lot different what you expected, and you have to go back and look to see, did you really include the true material cost? So that's step 2, which I'm taking for granted because it's reasonably easy to calculate. But I now want to go to step 3, which is our step 4. I'm skipping step 3 for the time being. And step 4 is a very hard step, probably the hardest step of the whole lot to understand. And it's basically trying to make an allocation for overheads in your costing in order to get your desired sales price. And I would suggest to you that an easy way to do this is to calculate what's called the overhead recovery case. Overhead recovery rate. And basically, it's quite often, you can do this over any cost, but I think a very useful way to do it is do it over labour. So in this case, if you think of X Limited, I've given you a very simple trading profit and loss account, turnover 500,000, materials 175, 10 direct staff, 15,000 each, 150,000, subcontractor, which is outsourced services to a third party, but it's part of producing your final product or service, 25,000, total variable costs or direct costs, 350,000, giving you a gross profit, 150,000. Remember, very important percentage, gross profit percentage, very important. Gross profit expressed as a percentage of turnover. And finally, overheads of 108,000, which I'm going to show you shortly, which gave you a net profit of 42,000 or 8.4%. Again, percentage, note the importance of percentage in the P&L account. Now, again, my 108,000 was the overheads. I just give you a sample. This will vary from business to business, but you see a lot of the normal things: insurance, light and heat, repairs and maintenance, etc. So there's overheads. That's how they were made up, 108,000. So we get to the next question. How do we work out an overhead recovery rate? Very simple. We take the overheads, which were 108,000. We divide it by the direct labour cost. You remember it was 15 staff or 10 staff in this case at 15,000 each. And what we do is we conclude that the overhead recovery rate is 72% of the direct labour cost. So what this is saying is, if we can calculate the direct labour cost, we then can also calculate an overhead recovery per labour hour. So the cost per labour hour worked, if you remember, was £14.86. 72% of that is £10.70. So we're saying per labour hour, you allocate overheads of £10.70. Now, if we then combine steps 3, 5, and 6, we're assuming that to make this product or service takes 1 hour only at £14.86. Then the overhead recovery is 72% of that, 1070, gives you 25.56. We're saying that the direct material cost, just assume that for the time being, is £9. And I've assumed in this particular case, for simplicity purposes, that there are no variable overhead costs. So variable costs. So basically what I'm saying here is that the total cost of making this product or service is £34.56. I'm then saying I'd like ideally to add on a markup of 20%. And here I get my desired selling price of £41.47. So I hope in a very simplistic way, we've given you a method to calculate your desired selling price, which is very important. And then it's important because understanding and analyzing costs really is really key to understanding your business, because costs are the major contributing factor to net profit, cash flow, and return on investment. Specifically, we suggest we need to look at what causes costs to rise or fall, and what you can then do as a business to influence those costs. Now, it's important to appreciate that costs are your investment in revenue-generating activities, because without costs, you have no business. Thus, while it's important to focus on business growth and revenue-generating activities, there should at the same time be a constant review of costs and business processes, because if you can get the goal to get the best possible return on your investment, then you'll make more money and you'll enhance your cash flow as well. It's important to avoid cost creep. That's cost creeping up. Unfortunately, it's probably at the bottom. It's the source of many business failures. So a knowledge of cost behavior is a good protection for your business. It's important to appreciate that activity drive costs, and that also the traditional accounting systems, our accounting statements, they quite often monitor the consequences, up 10%, down 10%, rather than the causes of the cost change. And it is the causes of the cost change which is very, very important. Excuse me. I've already explained the working definitions of variable and fixed costs, but suffice to say it's important to appreciate the fixed costs are only fixed within a certain time frame, and that all costs are subject to change over the longer term. So, having really highlighted how you understand costs and get to what's called the gross profit margin, we then really want to get in behind that gross profit margin in order to hit your profit target. And what we're really saying is that, again, as we highlighted slightly earlier, that all costs and revenues are ultimately driven by two things: products or services provided and customers. So we would suggest that you should conduct a gross profit analysis to determine which of your products or services are the most profitable and which of your customers are the most profitable to deal with. So you can work out a gross profit per product or service, or a gross profit even per customer, or per type of product or type of service, or indeed per geographical market or whatever. You can do it many different ways. So just as a sample, I'm going to use this example of a business with 3 products or services, A, B, and C. I'm using very simplistic figures, obviously, to highlight the points I want to stress. But if you look at this, you can see that the product C you might conclude is the best product because it's producing £250,000 worth of sales. But then you'd have to question yourself and say, is that right? And let's look at a wee bit closer analysis here. And you can see product C, yes, it is producing £250,000 worth of sales, which represents 44% of the total sales of the business of £574,000. But because product C has an individual gross margin or gross profit percentage of 20%, it is ultimately only contributing £50,000 to the total gross profit of the business, which actually represents 27% of gross profit. So although it represents 44% of turnover, that 44% of turnover is only contributing 27% of gross profit. But let's look at product B, which is producing £180,000 of turnover, which actually is 31% of total turnover. But because, it has a gross margin of 50%, it is contributing £90,000, which is 48% of overall company gross profit. So 31% of turnover producing 48% of the business's total gross profit. Now again, things aren't black and white, and I'm purposely going to do a little bit further analysis here, and then I worked out the average price per item and indeed the gross profit per item sold. You can see actually, believe it or not, product A generates more gross profit per item than product B, because product B, to produce the 180,000 turnover, you actually had to sell 30,000 units, where product B, as you can see, only had to sell 12,000 units to produce 144,000 of turnover. So again, there's no right or wrong here, but what we are doing is we're asking questions and we're interpreting the analysis. And by doing that, we get a far greater understanding, not only of our business, but once we start benchmarking with the industry, of the industry. And that's how ultimately you apply financial knowledge to improving the prospects of your business. Now, the truth is the cost, value, price, profit analysis is key, because it's the analysis which allows us to examine the effect on profit changes, the effect on profit of changes in price, cost, and sales volume. And that's something we want to go into in detail today and with the next couple of slides. And what we're really seeing is, in terms of working on price, you can increase profit by increasing your price, provided that any reduction in volume does not offset the effect of the price increase on the margin. And equally, you can increase your profit by decreasing your price, provided that the increase in volume is sufficient to offset the reduction in margin caused by the reduction in price. And we're going to give you a couple of examples of this in a second. Let's take this here. And this table took a lot of time to calculate, by the way. But the key point of this table is that all you need to know is the gross profit percentage of any product or service you're currently producing. And then you can apply this table. So what this table is saying is, if we assume that there's a gross profit of 30% for our product or service, I'm suggesting to you that if you reduce the price by 10%, you'll have to increase the volume by 50% to maintain the same gross profit. So let's take an example. Let's say we have 10 items of £100 each, with a turnover of obviously £1,000. A gross profit of 30% then results in a gross margin of £300. Now, if the price decreases, as I said, by 10% to £90, then if you think about it, the margin falls from 30, which is 100 minus 70, to £90 minus 70 to £20. And what this table is telling you is that because your gross profit is 30%, that actually you have to increase your volume by 50% to justify a price decrease of 10%. And you can see the proof of that is very simple. You then say, in order to get your gross profit in the margin is now only £20 per product, so you have to sell 15 of those products to generate the gross profit of £300. So the key point here is, forget about the unit prices, it's the percentage. Once you know the gross profit percentage, you can apply this to any prices. Very significant table. And similarly, quite often your staff will say to you, what volume can I afford to lose if I increase my price? Again, the key calculation and knowledge is to know your gross profit percentage, which we've explained to you earlier how to calculate. Once you know your gross profit percentage, no matter what the figures are in terms of costs or revenues, you can use this table to calculate the answer. And what this table is saying is that if I have a gross profit percentage of 30%, if I increase the price of that product or service by 8%, that then my volume can decrease up to 21% before I'll make less gross profit than I did before. So think about this. Let's look at the example again. We increase the price from £100 to £108 per unit. That generates a gross margin of £38, 108 minus 70. And 38, believe it or not, if you check that out, your gross volume could fall by 21% to 7.9 units and still make £300. So again, this is a fantastic table to be able to use, hopefully long after this webinar is over. So working on volume transactions, what we're saying really is you can increase profit by increasing the volume of sales, provided, if you think about it, as an example we showed, that the price remains constant, so the increase in volume translates into a higher gross profit, or excuse me, you can increase profit by decreasing volume of sales, provided that the resulting saving in costs outweighs the reduction in the gross profit arising from the decrease in volume. Now, again, working on variable costs, you can increase profit by decreasing variable or activity-related expenses, provided there is no change in the product or service quality that could have a consequential impact on the volume of sales. Similarly, you can increase profit by increasing, believe it or not, variable or activity-related expenses, provided that the improvement in the product or service quality allows you to win greater market share and to earn a premium price. So those really are reasonably simple stuff. You can do the exact same, you work it out with fixed costs. And again, if you just take your time and pause, you can see the benefit of this cost pricing volume analysis. And really what we're highlighting here is, and it's really important principle, that we're always quite often turnover focused. But just remember, it's easier to reduce costs than to achieve a price increase. And that's why we're always trying to innovate and R&D. I mean, I was fortunate to sit on the board with the great Dr. Martin Naughton, Glenn Dimplix, founder of Glenn Dimplix for many years. And he used to always say, innovate or evaporate. And he always used to highlight that every couple of months they were having to make the product better, but cheaper in order to make more money. It's a very interesting point, working on your costs. You can obviously then assess costs against industry benchmarks. You can do an industry analysis to establish your own benchmark within your business or within divisions, etc., etc. But it's a phenomenal way in order to assess how the business is going and how to improve it. Now, one further thing just before I finish on cost pricing and volume analysis is a thing called break-even analysis. People regularly say to you or me, what level of sales do I have to achieve to break even? That's to cover your fixed costs. Well, to be honest, because of how we have highlighted how the difference between fixed costs and variable costs earlier on, and believe it, because how we have shown, hopefully, you how to calculate your gross profit percentage, this is now a very simple calculation. You simply basically take the fixed cost of your business, you divide it by your gross profit percentage, and in this case, fixed cost of 500,000, gross profit of 35% suggests that the break-even level of turnover in order to cover the fixed costs is £1,428,571. Similarly, in the company B on the right, you can see you simply divide £500,000. I can see the slide just picked out the figure there, but £500,000 by 0.660%, and you come up with a break-even turnover level of £833,333. Now, we've covered a lot there, but hopefully we have got across that whole area of commercial profitability. Now, funding in its own could take 2 or 3 different webinars. So all we're just trying to touch here today is the core concepts. And whenever you say you need funding to go and do something, it's really important you think of some of these core concepts. What's the cause of the funding required? Because that influences the most appropriate sort of funding. Then to look at, there's different types of funding in terms of where you source it from, and equally risk and reward. We'll cover these very basically. We'll cover some basic rules in terms of bank funding. We'll briefly refer to COVID-19 supports, grant assistance, and accessing funding. But it's fair to say this is just a whirlwind overview. Identify the cause of funding, because believe it or not, depending whether you need the funding for cash losses or working capital or capital investment or R&D, or if you're fortunate to be involved, maybe just not a present from a tourism sector point of view of international trade, it will require different types of funding. So then basically in terms of your source of funding, as I said, if it's you can actually generate funding. You can see yourself from our management of debtors and creditors earlier on, cash flow within the business from better management of debtors or creditors, reducing your period of debtors payment, or days payment, and increasing the period you get to pay your suppliers. You can also, believe it or not, refinance existing unencumbered assets to release cash into the business. Then you have all the forms of bank debt, and I'm not going to go into those today. And you have various promoters equity fund, you have grants, you have loan funds, etc. But it's also important to appreciate, because this is important to understand whenever you're negotiating with funders or identifying what type of funding should you go for, that there is a risk-reward balance. For example, debt is a low cost, and the reason why it's a low cost is because it's a low risk. You have to pay your debt whether or not you make money. But equally, if you have a super year, you still only pay the provider of your debt the same money. It's a fixed cost. Whereas, unfortunately, if you don't make money as equity, the funds you introduce into the business can disappear. You can lose them. But on the other hand, if you perform super and make tons of profits, then because you took the risk you receive the greatest reward as the provider of equity or shareholders' funds into the business. So in terms of bank overdraft, obviously it's important again to appreciate you only use working capital funding such as overdrafts or invoice discounting or stock facilities for working capital funding. If you're thinking of hiring or purchasing a van or whatever, or a piece of equipment, you should always use asset-backed funding rather than bank overdraft. Again, business growth or expansion suits more commercial loans. And then obviously you have various forms of specialist loans as well. So I don't plan to go into the COVID-19 supports and unsecured loan assistance today in the course of the presentation, but certainly in the question and answer session, if anybody wants to ask us any specific questions about any of the COVID-19 grants or unsecured loan assistance, we're more than willing to talk about them, including obviously the new Northern Ireland Executive Localised Restriction Support Scheme and the new Job Support Scheme. Equally, in terms of grant assistance other than COVID-19, you need to be conscious of those from a financial management point of view, whether it's from Tourism NI or Invest NI, and obviously in terms, of Invest NI, various forms, whether it's employment, training, marketing, R&D, IT grants. Then you have the local district council grants, you have grants from local enterprise agencies. DERA, obviously just at present, the Rural Business Development Grant Scheme and the Rural Micro Business Grant Scheme are currently closed, but they will open again, and again, various forms of assistance, including cross-border assistance from Intertrade Ireland. Now, in terms of accessing funding, the fundamental debt principle that we must be very, and it's amazing how often we get this wrong, and this is what causes major cash flow problems for the business debt. You borrow for long-term needs with long-term debt. And I would make a very strong suggestion to you. If you have a lot of cash because of seasonality or something else, to pick your point, please do not take the urge to go and buy a fixed asset with that cash. Because then whenever you need that cash later on to fund working capital, to fund growth of turnover, etc., it won't be there. So basically borrow for short-term needs with short-term debt and match it to borrow for long-term needs with long-term debt and match the term of the loan, lease or HITS agreement over the expected useful life of the asset. Very important concepts that's important we appreciate. We briefly talked on working capital management earlier, if you remember, in the balance sheet, and really it's all about, I've touched on it a few times, but again, just like funding, this is a separate topic that deserves at least one, if not two webinars you wanted to go into great detail. You manage your debtors, your receivables, you manage your creditors, your payables, and you manage your stock and your work in progress. Very important, particularly in the service industry. Work in progress is a very important area to get into. How can you minimize the period between you incur a cost and the customer pays you? Some other perhaps practical tips that I'd like to suggest to you: key performance indicators, taxation, protection of assets, wealth management, senior management or board information packs, very important to the good governance and running of an organization. And the final one I'll touch on now before I go into the supporting slides, ethics. Now, if you think about it, you know, a few years ago, the key thing was, can I do it? Bob the builder, can I do it? Yes, I can. I would suggest to you now, the key decision is not, can I do it, but should I do it? And believe it or not, quite often, tragically, we're not able to answer that question a few years afterwards. But there's nothing worse to wreck your brand at present than ethics. You need to give serious consideration to having an ethics culture interwoven throughout your organization. In terms of key performance indicators financially, there's obviously non-financial ones as well. In terms of financially, we normally look at a number of key areas: turnover, profitability, productivity, gearing, liquidity, and working capital. And again, at a later webinar, we plan to go through these and how you can calculate these and assess these. Taxation, is important to appreciate that effective tax management and of your tax affairs can reduce costs and enhance cash flow. Now, it's important to appreciate if it's a sole trader or a partnership business, you pay income tax. If it's a limited company, you pay a corporation tax. Obviously, you need to be aware of the 4 minimum wage rates for various categories of employees. And a very important consideration in terms of running your business and effectively minimizing costs is the consideration of whether, if you have owners working in the business, whether you should pay the owners of the business a combination of dividends or salaries rather than one or the other. You can certainly consider tax-effective pension contributions if you have spare cash. You can explore the possibility to employ family members and exploit personal allowances for more than one person. Research and development tax credits are key at present. Particularly, you may say we're making no money, but that's actually irrelevant. If you're carrying out eligible research and development expenditure in accordance with HMRC guidelines, you can then actually get cash refunds, which is very important. And the final one I'd like to say, given the size of the business that we're talking about today, is to consider forming a group. And the reason why I'd say we're seeing this more and more common, that it's important to appreciate there are 6 possible reasons why in some circumstances a group may be more beneficial than direct ownership. Firstly, in terms of tax-free dividend, dividends paid by trading companies to the parent company are tax-free dividend. Thus, what does that mean? That means the trading company can transfer all profits to the holding company with no tax impact. Very interesting, very, very interesting. Similarly, the transfer of cash and assets. Both cash and assets for the trading company can be transferred up to the holding company with no tax implications so long as there's a 75% group relationship. Thus, this is an opportunity very smartly to protect your trading company assets. It's also an opportunity, by the way, to prevent people knowing your true profitability after a while, because you can put, for example, key assets, people, or even assets into a holding company, and then the holding company can charge a management charge to the trading company for those products or services. Equally, in terms of creditor protection, if the trading company has excess earnings in any one year and transfers those earnings up, then basically to the whole, if they transfer those earnings up to the holding company, this protects the earnings from the creditors in the future year that they can go after, because they're not in the trading company. And so long as there's not cross guarantees and they're up in the holding company, the creditors can't get at them. And normally cross guarantees would normally only apply to, believe it or not, bank or specifically a creditor who has forced you to provide a cross guarantee. And also, the group structure allows you to gain relief for losses. For example, a group of companies allows losses to be surrendered to each other between the companies to facilitate maximum tax planning if there's a 75% group relationship. That's why sometimes you might wonder why somebody buys a stupid company. Quite often they buy it because there's big tax losses available in it. Another advantage is efficient reinvestment. What do we mean by this? Well, what we mean by this is if the surplus earnings from the trading company are paid via tax-free dividends to the holding company then can reinvest some of these earnings into other assets or investments to diversify its holdings. Now, you have to, that compares or contrasts very favorably with a situation where the individual shareholders would have to extract the money from the holding, from the trading company. First of all, pay a tax on it at an approximate rate of about 38.1%, and that's forming the best tax extraction via dividends if they want to make those investments. You can see a massive potential saving and smart wealth management for business owners, family owner businesses in particular. And then equally, you have the whole area of sale of subsidiaries by a UK holding company. This is a very important relief as well, because a UK holding company may wish to sell its shares in a subsidiary and pass the money on to their shareholders by way of a dividend up to the holding company. On the disposal of the shares by the holding company, this typically triggers a capital gain on which corporation tax will be payable. However, this is the important thing. The UK holding company may benefit from a relief called substantial shareholding exemption on disposals of its trading subsidiaries, which would have the effect of making the entire gain exempt from tax gains, from capital gains. So there's very smart tax planning in there that it's quite complicated, but I just wanted to highlight it as issues you should think of. Asset protection and wealth management, another key area in terms of understanding the financial management of your business. And one thing I'd say to you is, if there's any lesson that the pandemic should have taught us, is this one. Please explore the possibility of not putting all your assets or eggs into one basket. Try to protect your assets. Consider how you can take so much out every year. How you can perhaps look at legal entities for your business. Do you take some assets out of your business and have it as the business limited company, assets outside the business? For example, do you consider owning the property in a SAS or a SIP, etc.? Equally, it's important that you recognize that true business costs include death and include key man insurance or income protection, because if we think about it, death and illness do not respect age. So it's important we plan for these things in advance, and certainly consider partnership or shareholders agreements. If you haven't done it, it's madness. If you're in a partnership or a limited company, you should make sure there's a partnership or a shareholders agreement. Now, one final point I just thought I'd share with you, because it's one we're coming across more and more. People ask you, what type of information should our management, senior management, or our board require? And this is where you define what information you want in your frequent monthly, if it's monthly or quarterly information pack. Again, there's no right or wrong to this, but there's some core information. Again, I highlight these: trading, performance, business. There's a very good discipline once you put these into your information pack every month, because once they're in there and you're measuring them or you're reporting on them, then believe it or not, it gets business and management's attention. Very, very good. And you can see all the areas it covers: health and safety, obviously staffing. It covers financial incentives, R&D, right down to business development, progress with key initiatives. And the final point, a very interesting point. In the last 3 years, 4 years, our own business, we have moved what's called the 90-day clock, where we have annual targets, but actually we divide them up and we run the business and organize the business on a 90-day clock with what's called rocks. We find it's far more easier to set targets right across the business in different divisions when we're using the 90-day clock, because people realize quickly what they have to do and what they're going to be judged on within 90 days. It focuses the mind. So with that, I'm delighted to pass over to my colleague, Ashok Thomas, to give you an introduction to financial modelling. Ashok.
Thank you, Feargal. In this session, I want to give you a better understanding of what financial modeling is. This introductory session will cover the what is financial modeling, it'll cover the why financial modeling, and it'll cover the how to go about creating the financial modeling. And at the end of this session, I will also go into scenario planning, give you an idea of what is scenario planning and how you would practically go about creating a scenario plan for your business. Now, what is a financial model? A financial model combines the accounting, finance, and business inputs to create financial projections for the future. Now, why is financial modeling important? Now, Feargal has gone through this, initially in his session, and these points are really practical and will help you understand why financial modeling is key. Number one, it is fundamental in helping businesses make decisions. Number two, it helps evaluate investment decisions. Number three, it helps assess pricing and profitability, and Feargal has gone into this in detail. Number four, it helps estimate funding need and borrowing requirement. And number five, it helps in scenario planning. Now, how would you go about creating a financial model? Now, as we discussed earlier, there are three parts to it. There is the profit and loss, the balance sheet, and cash flow. On a very high level, I will walk you through how to create a P&L forecast. So the absolute first step is to understand what the historical performance has been. So in this case, what we've done is we've taken financial statements for the last 2 years. We've looked at how much sales has grown. We've looked at the cost of sales. We've looked at the gross profit margins. We've looked at the wages, and we've looked at the overheads, and then the final net profit. Now, based on the knowledge that you have of your business and where you expect the business to go in the future, you project out for the next 3 years. So in this case, let's look at sales for a moment. There's a 20% growth in 2019 and 10% growth in the next year. So it is reasonable to assume that the business is going to grow at the same pace. But again, you'll have to adjust it based on your knowledge of the business and the trends that you expect. So in this case, we have projected out a 15% growth for the next 3 years. Cost of sales, again, the average of the last 2 years. We've taken 40% for the next 3 years. And gross profit margin, obviously, since the margin is the same, we've expected that to be same across the business. Now, if you expect improvement in cost margins, then please do project that as well. Wages and salaries, again, you can. What we've done is we've just increased that slightly year on year based on what we expect the wages and the salary costs to be. Your overheads, again, they should be largely fixed. Now, depending on the nature of your business, they may be variable or semi-variable. So depending on that, you have to adjust the sales projections. Now, once you get these numbers and put them down, sense check your net profit margin with historical. In this case, if you look at the historical trends, you're seeing the growth from 26% in 2019 to 34% in year 3 of the projection. Now, the next step would be to forecast the balance sheet. So what we've done here again is to look at the historical trends, see what the creditor and the debtor days has been, see what the fixed asset base is, look at the loan and of course the bank balance and the net asset balance. There's a very simplistic high-level balance sheet to just explain the fundamentals on how to project your balance sheet. So in this case, what we've done is we've shown a growth in fixed assets. This is assuming that there is a capital expenditure year on year. Your trade debtors has been 32 days and 30 days of sales for the last 2 years. Again, you may decide to invest in debtor collection and improve that year on year. So what we've shown here is a slight improvement in your debtor days from 30 currently to 20 by year 3. Trade creditors, again, we've taken the average of the last 2 years and we've projected out the creditor balance. The loan, again, depending on the repayment schedule of your company, you can project what the loan balance is going to be. And then, of course, the bank balance. Now, depending on the Excel model that you use of the software, the cash flow will automatically project based on the inputs that you put in. So in this case, as you can see, there's a net profit, which is a function of the P&L that we projected out. We've got the purchase of fixed asset, which is coming in depending on the capital expenditure that you've forecasted, the changes in working capital, which is purely the improvement that you've made in your data collection process has improved your cash flow, and then of course the repayment of loan, which is depending on your repayment schedule. Now, that's on a very high level. That is how you project a P&L, a balance sheet, and a cash flow. And there are many three-way financial modeling softwares in the market that you can use to make this process easier, or you can just simply use an Excel spreadsheet. Now, in this section, I want to introduce you to a very important concept, which is scenario planning. And I think it can be an incredibly important tool to help you navigate uncertain times like the one that we're facing now with the COVID pandemic. Now, the first step to scenario planning is to create a customizable financial model, which we have already covered. Now, based on a snap poll that we had performed recently on micro and small businesses operating in the tourism sector in Northern Ireland, we found that only 8 in 10 businesses don't prepare detailed financial projections. Now, there were many reasons that were given for not preparing financial projections, including familiarity with seasonality cycles, steady performance year on year with minimal changes, and a very high level approach with regard to taking investment decisions. But that approach does not work in the uncertain times of today. Let's take some live examples of what we've seen recently. A Belfast restaurant recently reopened, bringing over 20 staff out of furlough, following a $1 million investment in refit and refurbishment, making the restaurant COVID compliant, only to be hit with a 4-week circuit breaker closure. Another example is a 131-bed 4-star hotel had to temporarily close after 2 of its staff tested positive for COVID-19, resulting in hundreds of employees being sent home for several days. A local entertainment company which does live shows had to cancel a fully booked event and face the daunting prospect of refunding thousands to customers and not being able to recover deposits paid on advance for booking the venue. Now these are such stark examples, and the question really is, how can businesses prepare to overcome a specific set of uncertainties so that the core business survives the short-term impact of COVID, right? Let's unpack that statement for a moment. The 2 key questions that we want to answer here in this session is, number 1, what are the specific set of uncertainties that the business needs to prepare for? Number 2, how can businesses prepare for them, right? And when you think about it, we can actually list down what those uncertainties are to some extent. If we look at what we're facing now currently with the 4-week lockdown, it could be the 4-week lockdown itself and its impact on the business. It could be a local COVID outbreak in your locality or in your business. It could be the eventual tapering off of government supports and schemes. It could be issues with suppliers. It could be debtor collection issues. Now, those will be very unique to your business and you will need to identify them. The second step would be to quantify the financial impact for each one of those certainties that we've identified. Let's take the 4-week lockdown and the local COVID outbreak, right? Again, it'll be unique to your business. Loss of sales for a 1-month period, let's assume it's 50,000. Direct cost foregone because you don't make those sales, you don't have to make those purchases, 15,000. fixed overheads and salaries, which you have to incur anyway, like let's say your rental expense is 20,000, deep cleaning costs, let's say there's a local COVID outbreak and there are cost rescheduling and deep cleaning, let's say it's 5,000, and then the financial loss incurred would be your fixed overheads plus your deep cleaning / rescheduling costs. Tapering off government supports, again, the amount that you have been receiving, and again, if that was not received the next month, what the impact is going to be. Supplier issues, again, not being able to secure goods in time, withdrawal of supply credit, and price escalations, which we've seen over the last 3 months with several of our clients, is again creating a lot of working capital issues. Again, in this case, we've just taken an example of £25,000 cash to be paid up front, which has an immediate impact on your working capital. Issues with debtor collection, again, with the uncertainty, many businesses have issues with insolvency. So there are probably debtor balances that need to be written off. And again, you were expecting that money to come into business, but that hasn't because the debtor has failed to pay. So that can create an immediate funding requirement. Now, how do we quantify that? So step number 3 would be, step 1 is to list them out, step 2 to be quantified, and step 3 would be to look at the overall impact of your cash flows. Now, very quickly, let me just run through both these scenarios. The first one is normal trading cash flow. So you expect, in normal circumstances, you would expect a net cash flow to your business of £50,000 for a month, right? That is a summary of your debtor collection, your customer receipts for your current period, your payments to suppliers, supports received from the government schemes, and loan repayments, right? In your scenario adjusted cash flow, you're not receiving anything from your debtor because of debtor collection issues. You've not made any sales because of the 4-week lockdown. Your suppliers, you have to largely pay your fixed overheads and, of course, your other costs. Your support has reduced and your loan repayment remains. So if you look at the variance, the delta between both these options, you'll see it's almost £90,000. So there's a 50,000 that you would have expected, but there's a negative of 40,000 in this month that you have to fund. Now I think this gives you a best estimate of the financial impact of the lockdown, and we suggest that every business should do this. But unfortunately, due to the nature of this pandemic, several waves of closure and lockdown are expected, and therefore it is only prudent to prepare for an extended and repeated impact. Over the last few months, we've been working with management teams of businesses to prepare them for multiple waves of lockdown. Now, what we suggest that businesses do is to prepare a triple dip financial model, which will ensure that companies are prepared and equipped to absorb multiple shocks to the system, right? Now, here is a simple chart illustrating what I'm talking about. So if you look at this carefully, this shows the financial model that we've made for one of our clients. So you can see how the green line on top is the normal cash balance that the business expected with normal trading. But if there was a lockdown, so if we consider the scenario adjusted cash flow that we just talked about, and that impact was repeated 3 times, we project out what the impact on the cash flows in the business could be, right? So let's look at the green line for the moment. That is the normal cash flow. If you look at the gray line below that, you'll see 3 distinct dips. The first dip is for a 4-week period. And then let's say there's a 4-week lockdown, you would ultimately expect to recover. But again, what has happened is you've eaten into your cash reserves that you've maintained during the 4-week period. But then after that, you're hit with another wave of a lockdown. So in this case, we've shown another dip. And then, of course, the third dip, the same concept. So if you look at this carefully, now most businesses prepare only for the first wave or maybe even the second wave, but we believe it's financially prudent to prepare for 3 waves. So what we suggested in this case was that the business enhance their overdraft facility. So it had a nominal amount as an overdraft, but just to make sure there's enough of a reserve and a headroom and to ensure that if there were 3 different shocks to the system, project out what really could happen and sort of game that scenario and see the impact on the cash flows. I think it was really beneficial. So what they've done as a result of the triple dip financial model is to enhance their overdraft facility so that they know that their business is secure in the event that they're hit with 3 consecutive lockdowns. Now, some final tips on financial modeling and scenario planning. get the balance right between simplicity and complexity. It's very easy to get carried away with a very complex financial model, but just make sure that it is simple to understand, it's simple to adapt and change, and it makes sense. The second thing would be you'd rather be broadly correct than precisely wrong. So again, sense check the numbers, make sure it makes sense, it's reasonable, it's not too aggressive or ambitious, but you take in your best judgment with regard to the assumptions. The next one is an obvious one. Use the experience gained from the last 6 months and plan for all likely scenarios. It's been extremely interesting to see businesses over the last 6 months and see how they react. And I think using the experience that you've gained from the last 6 months, I think would be very essential in projecting out what the financial performance could be. And again, financial modeling is not a one-time exercise. Embed that to your management culture. Now, that concludes my session on scenario planning and financial modeling. Feargal, back to you.
So to conclude, hopefully we provide you with an overview and a refresher on key matters affecting the financial needs of your business as it continues to try and operate and navigate its way through our current difficulties in terms of COVID-19, etc. But more importantly, as it plans for recovery post-COVID-19. So certainly Ashok and myself, along with my colleague Aileen McShane, are looking forward to participating in a question and answer session shortly now. And one other point I'd like to draw to your attention, if today's webinar has raised an issue or a question that you would like to discuss in private, you can get in touch with the Tourism NI via the email to industry.development@tourismni.com. And Tourism Northern Ireland will organise for you to get a call from a finance expert tomorrow morning. So what remains for me to say is to thank you very much for participating and joining us today, and I hope you have gained something from today's webinar. Thank you very much indeed.